A cash flow forecast can be used to help with the ongoing financial management of a business. It helps to identify time periods where there should be enough cash to purchase equipment, spend money on advertising, or make other investment decisions. It can also show time periods where there may be a cash shortage, so that the business owner can make plans in advance to either invest more cash in the business, reduce expenses, or increase sales in order to compensate for the shortage. The first kind of forecast we'll look at is the comparative sales forecast. In this example, most of the sales during the year are identified as off-peak, where the business earns about $5,000 per week, 42 weeks out of the year. But then there are times during the year when sales are exceptionally high. These time periods are identified as peak season, and they earn about $15,000 per week, 10 weeks out of the year. You would then just multiply the weekly sales of those two time periods by the number of weeks during the year, then add the totals together to come up with an annual cash flow forecast. For a business that has sales numbers that are consistent throughout the year, you can use the average sales forecast method. Here you would just multiply the average sale per transaction times the average number of daily customers to come up with a daily sales number. You would then multiply that number by the number of days the business is open during the year to come up with the annual forecast number. If neither one of these forecasting methods apply to your business, you can always come up with an annual forecast number based on what's typical for your company's industry or based on your company's sales history. Regardless of which forecasting method you choose, you need to know what the monthly forecast numbers will be compared to your monthly break-even dollar amount, which we talked about in Lesson 1. We now want to calculate what's called margin of safety values, which describe the difference between actual or estimated sales revenue numbers and the break-even point. To calculate the margin of safety in dollars, we will subtract the break-even dollar amount from the total revenue amount. Which gives us $3,000. In other words, the restaurant's estimated sales revenue number is $3,000 above the break-even point. We also want to know what that number is as a percentage, because values described as a percentage will often give us a more clear picture of how meaningful they are. So we'll take the margin of safety dollar amount and divide it by the total revenue amount. This tells us that the estimated sales revenue is currently 27.3% above the break-even point. Now, depending on the type of industry, current economic conditions, or competition, that margin of safety value may not be high enough. Excel has a tool called GoalSeek, which can be used to help us make adjustments to this break-even analysis. We're going to now evaluate a balance sheet by comparing assets to liabilities, and the first thing we want to look at is working capital, which is current assets minus current liabilities. In most cases, it's important to keep this number as high as possible because it can be a safeguard against downturns in the economy, increased competition, lower than expected sales, or increases in costs. We also want to take a look at what's called liquidity ratios, which show comparisons between assets and liabilities. The current ratio is calculated by dividing current assets by current liabilities. For most companies, a current ratio of 2 or higher is an acceptable number. Here's an example of a catering business that created a spreadsheet so that changes in the quantity, cost per pound, markup percentage, and the damaged goods estimate will determine what the sale price will be to the customer. So if they change the quantity from 50 pounds to 75 pounds, for example, and lower the cost down to $2.79 per pound, the price to the customer will also go down. Let's also look at an example of a business that wants to evaluate an opportunity to invest in direct mail advertising, which is going to cost them $900 per month. Ad campaigns usually work best when it's tied to some kind of offer, so the price will be lowered to $26 per unit. They're expecting the sales volume to increase to 520 units per month, and since they're buying a larger quantity of products from the distributor, they are also able to lower the cost of goods sold by $3 per unit. You can see that by inputting these assumptions, that it results in an increase in operating income. Understanding payables and receivables will help you to avoid some of the problems that cause a business to operate at a loss or become financially distressed. Some of the major problems that I've seen include unpaid invoices from customers, bad credit terms with vendors, and unpaid tax liabilities, which can all have a major impact on cash flow. Here's an example of a general contracting business, and they want to have on receipt as a payment term for the majority of their customers. By doing this, they believe that payments can generally be expected within 10 days or less, and it's a payment term that can be used to discourage customers from waiting to pay their invoices. They decide to use Net 45 payment terms for some of their corporate and government clients who may have a policy of paying their vendors within 45 to 60 days. And then 2% 15, Net 30 will be the credit terms for some of their larger customers, because the 2% discount will offer a cost savings that's high enough to get a response and help them to get paid sooner. This shows you an example of what an accounts receivables journal looks like after about a month of entries. And here you can see the totals for the amounts owed, the amounts paid, and the grand totals. This gives the business the information they need to see if they're bringing in enough new customers, the ability to compare the amounts owed to the amounts paid, and to see if there are any individual clients that are past due that they need to collect from.